Thank you for joining us today. Today we have an update on the first quarter with Winthrop Capital Management. And we've got Adam Coons with us. He's the portfolio manager, and Luke Stone, and he is the senior investment analyst. So thank you so much for joining us today.
Yeah, great to be here, Courtney. Thanks for having us.
So let's see, how are concerns about the banking industry impacting equity and fixed income markets?
Yeah, so I'll kick it off and then let Luke kind of speak to the detail of the banking industry as a whole. I would say to start with fixed income, it has led to two different dynamics. One, you've seen interest rates come down quite a bit. We're below 3.5% on the 10-year now, and that's largely driven by kind of this narrative that's being pushed that, but this is really kind of a early signs of a recession, and because of the causes of these bank failures from the higher interest rates, that the Federal Reserve's basically going to be forced to at least pause, if not begin to cut rates. So like I said, we've seen quite a drop in interest rates, but at the same time, we've seen more of a risk-off tone in just risk markets as a whole. So corporate bonds and other type of bonds outside of treasuries have actually kind of had a negative time during these last couple of weeks. And then equities as a whole, largely we saw some declines, but aside from increased volatility, I would say if anything else, markets are just choppy. But Luke, I'll let you speak more into the detail.
Yeah, Adam, I think you bring up a good point with the choppiness in the market. And I mean, look, we saw two of the top 5 biggest bank failures to ever occur in the history of the United States occur within just about 5 days of each other. So with that, there's reason to be a little concerned, right? But when you really dig into the details, when you look at Silicon Valley Bank, the associated failure there, as well as Signature Bank out of New York, the failures there were more of a mismanagement issue than kind of at a broader tone of, I'd say, a systemic issue across the banking sector. What you saw was managers that got a little greedy from the bank perspective, and then regulators that kind of seemed kind of a little loose with the regulatory guidance. So with that, we've seen this as a great opportunity to look into the financial sector. We're seeing regional banks with anywhere from 2 to 5 year paper yield about 7%, and then the large money center banks, you think your JP Morgans, your Wells Fargos, those are yielding 5 to 6%, which we think are incredible yields in the current market.
Great, well, thank you. Let's see, do you guys anticipate any pivot in Fed policy or rates?
So I think we will see a pause. I think we'll probably see one more hike, maybe 25 basis points in May, but after that, we think the Fed will likely pause. Any pivot would really come down to seeing a sharp slowdown in the economy or a recession of sorts. So right now, no, but it really is dependent on what's happening, A, in the banking sector, B, in the commercial real estate sector, and then just as the consumers as a whole. Those 3 factors will need to see a large shift before the Fed would actually begin to reduce interest rates.
Just to add from a market sentiment perspective, we've seen the futures markets in the Fed funds futures markets move dramatically. I think since the last time you and Greg spoke, we were looking to, at least the market was pricing in a pivot somewhere in the June timeframe, or a pause rather in the June timeframe. Now we're seeing projections of a pivot to take place in September. So while that might not be our view, that's kind of the broader view in the Fed funds markets.
Got it. Okay. Let's see here. How have you adjusted the portfolios this past quarter?
Yeah, so first we'll kind of go through how we entered the quarter, and then where we kind of made changes here in the last couple of weeks as markets have changed. So coming into the quarter, we continue to be overweight large cap domestic stocks. And then one of the changes we made through the quarter, maybe got a little lucky with the timing, but we did have a preferred stock sleeve within the models. That was ticker PFF. And a large part of that are financials. it actually was outperforming everything through the first half of the first quarter, was up roughly 10% at one point in time. So to us, that was overvalued. So we did sell that. We cut it in half and moved it actually into short-term treasuries. It was a very safe bet moving it into that. But like I said, we just saw the valuation looked like it got overextended. Because of all of this bank dislocation, it quickly reversed and is now negative on the year. So it gave away that entire roughly 10% gain. So that sale worked well and gave us some dry powder if markets continue to dislocate. The other thing we did was when banks did dislocate, we added to the regional bank sector. So I would say financials as a whole are slightly overweight now. We came into the beginning of the year slightly underweight, and now we've shifted to a very, very slight overweight, and that's really come from that sleeve of regional banks that we've added. As Luke spoke about, with these stocks down, anywhere from 20 to 50%, we just saw tremendous value. And I will give a caveat. We think volatility will remain here. There's still some things to be worked out. But when we look at the sector as a whole, we think the banks are sound. The assets themselves are very good. This is more of a, like Luke said, a mismanagement of the asset and liability sides of the sheet. So we think that can be resolved, and we can get past that. The Fed has opened a facility that can kind of help get through this. So we do think banks come through this. It may take some time. Like I said, we will see some volatility, but we see value there.
So I was just shocked to see the NASDAQ was up, I think it was 17% over the first quarter. So what's your take on tech going forward?
Yeah, so similarly, to kind of give the full background, we've been overweight tech. We remained overweight tech coming in the first of the year. That worked. Tech itself, that's just the XLK, is up over 20% year to date, and that's obviously a large part of the NASDAQ is tech. So that has worked. Now we're obviously coming off a base of last year. Tech had a very difficult year. So I think what we're seeing here is just a readjustment of valuations as interest rates came down. I don't like to use interest rates all the time for why tech outperforms, but I think in this case, we are seeing some of that sensitivity as interest rates come down. It will help growth stocks, which i.e. helps tech. And you've seen some of the worst performers of 2022 be the best performers. You've got NVIDIA up 80%, obviously Tesla. And so those type of stocks are just up a great deal, and that's helping obviously propel the NASDAQ. But going forward, to answer your question, we do think that they will continue to outperform. If the Fed pauses or even pivots, that will help with the growth story. So, and will help with some of the valuation metrics here. So we are bullish on tech. We remained overweight and will remain that way.
Great. I appreciate the update. Anything else that you think our clients and investors should know about?
Just like I said, just to expect volatility, but just, if you've set a good foundation and strategic asset allocation, just remain true to that. That we might see some, dark clouds, but if you just stay to that allocation, you'll be fine.
Great. Good advice. Thank you so much.
No problem. Thanks for having us.
Okay. Bye-bye.
Bye, Courtney.
Thank you.